Hi, everybody. So I have a poll up for class. So we'll wait about a minute or two for people to get in, and then we'll go ahead and go over the poll. So as much as possible, everybody respond to it. Okay. Um, all right, so I think there's some brief beginning class announcements before we end the poll.
All right, thank you, Sasha. Hello, everyone. Welcome to week 14. And while waiting for others to join, please take a moment to answer the poll on your screen. So, just wanted to say some quick reminders. Please remember to turn on your camera during the entire session. If you cannot, don't forget to notify us. Notify one of our VA there, Basha, notify the reason why you cannot open your camera so that we can note your participation. Also, it is also very important that you make sure that your Zoom display is your full name so we can also accurately record your attendance, especially that we are exporting some data from Zoom. So it is really important that your Zoom display name is on your full name. And if you're also experiencing any technical issues, please don't hesitate to notify Basha here, or you can also message me. So that's all for me. Thank you so much. Gonna bring it back to you, Sasha.
Thank you. Okay, so I think pretty much everybody has answered. So we can go ahead and close the poll, and I'm going to go over it. So we today we're going to go over stocks, bonds, and real estate, which is essentially these are all designed to help you with growing your wealth over time. So the first question was, what scares you most about investing? Losing money, not understanding how it works, market up and down, and feeling like I'm starting too late. So all these are valid concerns. I'm actually going to address each one of them. So losing money. That is a valid concern. And that's why it's always really important before you step into anything that you do that you're able to get advised on it, whether it's someone who, let's say, already deals with the stock market, maybe someone at the bank that knows about it, knows about the different vehicles to invest, or, like for instance, real estate, which we're going to talk about, someone who already has real estate, someone who's a real estate investor, discussing that, networking, meeting people in real estate. Um, but losing money, it tends to be that you it depends on the vehicle that you use. Usually, like real estate, it tends to go up in value, right? So you want to look to buy real estate in areas where historically things have gone up. Sometimes things go down, things change their cycles, but for the most part, in many areas, things go up in value. Same thing with the stock market. There might be ups and downs, but for the most part, historically over time, it goes up in value. So a lot of it has to do with long-term growth and patience. Not understanding how it works, again, doing a lot of research and talking to people and just being curious and asking questions can help solve that insecurity about it, but also just help you learn how things work, right? Markets up and down, not a lot of you are afraid of that. That's a natural part of a lot of things. So again, just understanding those trends and historically how things have gone up and down. And you're able to weather that storm when you know more about the thing that you're investing in. And then feeling like I'm starting too late. So the good thing about, you guys all being in Youth Champions is that you're learning about something that many people in their whole life never ever learn about. The other thing is there's a lot of things that you can do when you're young and when you start out and have a job. One of them would be you can go to the bank and talk about this or Google it, but opening up, an IRA account. And that's a way for you to, put money aside. It gets invested into the market, and then you can use it tax free in retirement. So that's a long-term vehicle, right? But it's designed to help you year over year sort of grow that. And that's something that you can do when you're young, as sort of a preliminary thing. But a lot of the stuff starting too late is simply the result of maybe procrastinating because you don't do any of the research about it. So that's something that can be resolved because you're all here right now and going to start learning about it, and then you can continue to learn about it. Um, okay, next thing. Let me turn off my phone. What would motivate you to start investing? Building long-term wealth. Yes, that's all of your guys' goal. Extra income from dividends or rent. That can help. A lot of the times when you have extra income from rent, you can save it or you can, use it to reinvest in your property. Or if you save up enough of your rent, you could probably buy more real estate. That's one way. Advice from someone you trust, of course, because, the more that you're able to talk to someone that you're comfortable with, that you know about, that you trust, the more you're willing to step out of your comfort zone and start investing yourself. And then curiosity about how money grows. None of you are curious about how money grows. I think you know it grows. You just want to know how you make your money grow. If you had to choose which type of investment seems safest to you, bonds, probably the safest. We're going to talk about those. Index funds, also pretty safe. They're diversified. Real estate is pretty safe. Individual stocks. Individual stocks and index funds are kind of two sides of the same coin. You can own individual stocks or you can own in just a whole index, which is comprised of a bunch of different stocks. A lot of people do both. So they have an index, which typically, like if you set up an IRA and you have the bank manage that money, they do it for usually a small fee. They'll probably put it in index funds. And they'll probably put you in a very aggressive index fund, which the bank will explain that to you. But there's kind of aggressive, there's very safe. But when you're younger, they tend to put you in a more aggressive track. So the index fund will probably be full of a lot of technology, in those kind of sectors. But as far as individual stocks go, like if you're a huge fan of Apple, you love Apple, you think Apple's great, you could buy a portion of a stock, you could buy one whole stock, right? And that more has to do with you knowing the company and having some sort of background in a company. It's good if you know about a company perhaps before it even goes public, or when it's growing. So, all things that this really comes down to is getting educated and getting informed as much as possible so that when you make a decision, which one day you will make, you have as much information as you can possibly get. So let's go to the second slide, which is the overview of last week. Okay. So last week we covered mindset fundamentals, right? So we revisited key mindset concepts and explored how a clear vision and intentional goals create direction and purpose. So we went over SMART goals. We want goals that are going to actually challenge us, make us get out of our comfort zone, help us build resilience and personal growth. You don't want goals that are not really going to do anything for you, right? Excuse me. Through curiosity, reflection, and consistent effort, we gained tools to grow and show up as our best selves in the weeks ahead. So, really, anything that we do in life, it's somewhat premised on curiosity. So, when you have goals, it's because you're curious about the outcome, you're curious about how the steps to that outcome will make you a better person. So, you want to always be as much as possible curious because, again, that's just good for life. Let's go to learning objectives for today. So today we're going to understand how stocks, bonds, and real estate work. Those are three of the most common investment tools. The tools of ownership include different aspects of ownership, though. Could also include lending, like on property, like income property. We're going to talk about risk, time horizon, and the compounding effect of long-term results. You can distinguish between investment options like individual stocks versus index funds versus bonds versus REITs, and see how diversification reduces risk and supports steady growth. And we're going to identify when and why investors choose each asset type based on their goals and risk tolerance, and learn how they work together in a balanced portfolio for long-term security and wealth building. So some of these things you'll have over time, a few of them. You might own a few individual stocks, you might own a few bonds, you might own some real estate yourself, you might have money in the index fund. So all of these things together, it's called diversification, right? You might not put all of your money into real estate. You might not put all your money into one kind of real estate. You might not put all your money into one stock. You might put it in different kinds of stock. So we call that diversity. And the reason why is your money will grow at different times, but it'll be more secure. You'll have money that might grow a little bit faster. You'll have money that will grow long term. And then you'll have money that you'll be able to have access to in the event that life happens and maybe an emergency comes up and you need to be able to pay for something. So that's why you diversify. And the age-old adage, which is don't put all your eggs in one basket, right? So we're going to talk about that today. So let's go to the next slide. So just a disclaimer, I'm not a financial advisor. None of us here at Youth Champions are financial advisors, or any of the staff on the call. And so none of this is going to be considered financial advice and shouldn't be financial advice. All this is simply meant for informational purpose so that you can yourself take this information and springboard into doing your own research, potentially one day through talking to either a trusty financial advisor, the bank, or some sort of industry expert will be able to then make those decisions for yourself in the future. But this is more to bring to your attention that these things exist. Let's go to the next slide. So we're going to talk about stocks first. So we're going to talk about kind of ownership and growth. So stocks represent an ownership in a company. So when you hear about, companies are going to have annual shareholder meetings, when you buy stock, you're a shareholder. So a lot of the times why companies do what they do, the really big companies, I'll bring up names like Tesla, like Apple, like Microsoft. All of those companies are there to grow the company so that individual shareholders, which maybe one day might be yourselves, your stock is growing, right? And so the more that your stock grows, one day maybe you'll be able to sell the stock and get some of that money back, get some of the growth. Maybe you are able to borrow against the stock, which is similar somewhat to borrowing against real estate, but in this case, it's the stock because the stock is going to grow. So it gives you access to money in different ways. But the goal is to make the stock grow, right? So the different ways that you can invest in stocks is like an individual stock. Like I can go and buy one whole share of Apple, or I can buy a percentage of a share of Apple because maybe I can't afford the whole share. But my percentage will just keep going up in value as the shares go up in value. The other way you can do it is you can buy index fund or ETFs. And so those are essentially, they look at a whole class of stocks. They look at a whole bunch of different companies and they pull them together. They take the money and then they invest in that index, in that fund. So you're investing in a bunch of different companies at the same time. So there's also what they call like growth stock, and then there's dividend stock, right? So from dividend stock, the price tends to grow a little bit slower. So the value of the stock grows a little slower, but you get money out of that stock every year. And sometimes they usually pay it annually, sometimes they'll pay it quarterly, but you'll be able to get money back from that stock. So it depends, the more that you own of a company, the more of a dividend that you will get. This is kind of unrelated to stocks, but a little bit related is insurance companies. If you ever had insurance or your parents have insurance, what insurance does is it collects what's called a premium. So if you have a car insurance, you pay the insurance company money every month, every year. So in the event that something happens, like you get into a car accident, then you're covered for their damages, for maybe medicals, things like that. So what the insurance company does is they take all that money and they invest it because not all the time are they spending the money, right? They're collecting the premium. Hopefully one day you don't have to use it. But in the meantime, the insurance companies are investing that. And some insurance companies will pay out a dividend to you for having your insurance policy. And so that's also kind of a way of getting dividends as well. It's like you might even get a dividend from the insurance company. So that is, again, when you invest the money, you want to be able to balance ones that give you money back, like dividends, and ones that are growing. So the ones that grow faster and grow a little bit more tend to not give dividends, or their dividends tend to not be high because they take that money and they reinvest it back into the company. Whereas other companies, they reward the shareholders by giving them a little bit of the money. Both want to grow the company, but it's just different ways of treating the shareholders. Um, the stock market rises and falls daily. So if you were to look at the stock market in a day to day, it's like this, right? And then if you were to zoom out a month, it's going to look like this. And then you zoom out, 5 years, it might look like this, kind of depending on historical events. And if you zoom out more, it's going to be like that. That's typically what the stock in the long term, 10 years ago to today, up, right? So the longer you hold something, the more it tends to grow. So that's why some people buy stocks and they hold it for a long time. That's going to be a similar concept when we talk about real estate. So long-term US stock markets returns have been historically outperforming bonds. We haven't gotten to bonds yet, but we will talk about bonds. So that's why people invest in both because stocks tend to grow in value and give you more money essentially than what bonds would do in usually the same amount of time. The S&P 500, if you've ever heard of that, has basically that's the index that a lot of people invest in that historically over time has had long-term growth despite maybe short-term volatility, right? So there might people talk about crashes. There was a huge crash in 1929, right? The Great Depression. So there's times where there's small volatility, stocks go down, stocks go up, stocks come down. Peak of the market, bottom of the market. And those are things that sometimes you can gauge from research, but other times it just depends on maybe a bigger picture, like what's going on in the economy, maybe what's going on in the world. So the benefit of diversification is that some things won't have volatility and other things will. So you hedge against that by having different kinds of investment vehicles. Let's go to the next slide. So we're gonna do a workbook question. I'm gonna give you guys 3 minutes for this. The question is, would you prefer buying individual stocks or funds? And what might possibly influence that choice? So in other words, maybe you don't know. What would you need to know in order for you to make a decision one way or the other? So let's do 3 minutes. Let's add a timer and then we'll come back and share. Okay. So I'm gonna have Alaya Aceves, who's been very into learning about the stock market. Why don't you share with us your answer to the workbook question?
Sure. Okay. Let me go through it. So I've actually done quite a bit of research about it in the past because I've actually been interested in investing in stocks. So I haven't learned too much. I say I learned a good amount. Um, I prefer buying individual because there's less risk of fraud, and in the long term it is good for beginners as well, and since it requires less expertise, but also like time wise I think it's good, like so you have it said and done basically.
Yeah, so the individual stocks, that tends to be based on either your familiarity with the company that you're investing in or research in general. So, one way that people keep track of those things is one, they keep track of industry news, right? What companies are having IPOs, which an IPO means initial public offering. So they're a private company that for the first time is going to take in investor money. So it's going to have shareholders. And a lot of times people go from a private company to shareholders so they can get access to what's called capital. So your investment money, you buying shares, is actually you giving the company capital so they can use that money to grow the company, right? So the more you know about a specific company, obviously the more comfortable you would be in investing in that company since you know what they needed money for, what their growth projections are. Then you also look at, their annual disclosures. So every year they have to basically talk about what we did with the money, what we're doing to grow the money, what our plans are, what our outlooks are, what our industry trends, what's helping us, what's hurting us, just the general changes. So the more you get educated about a company, obviously the better it is for you if you plan to buy individual stocks. So the benefit of buying something like a fund is that maybe one company is doing great and another one's doing okay and another one's kind of down, right? And instead of buying in just one because you don't know if they're going to be great, kind of okay, or on the downside, if you buy in a pool of stocks that are similar, then they average out to usually grow. So there's no wrong way to do things. There's no bad decision, wrong decision in that sense. There's just uninformed decisions, right? So the more you know about something, the more you do research, like Alaya has been doing, and then understanding. Because, like, instance, you could download an app like Public or Robinhood, right? And just buy stocks. You could buy it right through the app. If you wanted to set up what's like an IRA, which is an investment account, which helps you, in some way with your taxes, you might want to go to the bank because that's, what they know about. And the bank could also, with their expertise, help invest your money. And then some people do both, where they have some money that they buy on, stocks on their own with, like maybe through Robinhood. But then they also have some money that they have someone else invest it for them and manage it for them. And those are just sort of two different ways to do it. So the main thing that influences people's decisions is just one, knowing about it, and then two, asking around. And I mean, you can ask, like, if you know anyone who owns stock, hey, why do you buy the stocks that you have? Or what are your philosophies or your ideas? Or, what do you look for if you decide that you want to buy, sell, or trade, right? The stock market is very expansive. This is just talking about buying stocks. You could buy options on stocks, which is like advanced even for me, where you sort of are trying to essentially bet what a company may or may grow or fall. So you buy an option on it. That's like I have not read enough about that. But there's this stock market in that sense is very expansive. So you're really limited to how much research you want to put into it. But understanding the fundamentals, researching the fundamentals will definitely get you very far. And there's plenty of books on beginner investing. If you don't want to read a bunch of books, there's plenty of videos on it as well. So let's go to the next slide. And thank you, Laya, for sharing. I liked your enthusiasm. Okay, understanding bonds. So bonds are a little bit different. So bonds are loans you give to companies, governments, or cities. So it's a little bit different than the value going up. It's money that's being borrowed. Different bonds have different levels of safety and return. So US government bonds, there's investment grade corporate bonds, and there's municipal bonds. So some of these things, if you've ever, heard your parents talk about voting or seen a ballot, sometimes on the ballot is, the government wants more bonds, meaning we want to get a bond, we want to raise money so that we can do something. We want to grow, school programs for music, or we want to have, more funding set aside for fixing up infrastructure in the city. So they might go and put on the ballot that they want more bond money. Stability, they tend to be stable. Because they're not volatile quite like stocks are. And when you have bonds, again, they're essentially loans. So like the government tends to be a safe bet because the government has money to pay back the loan, right? To pay back the bonds. So most bonds pay interest, and there's bonds at different levels, meaning there's bonds at kind of different time frames. You could have a short-term bond, you could have a long-term bond. So it's good to have bonds. You can buy a few bonds when you're younger. And then, the longer you have them, the more interest you're able to collect on them. So they typically, bonds are usually in 6-month increments. And then there's a maturity date. So the issuer will pay you back the original amount you invested, which is called the principal, and your interest by a certain maturity date. But they're fixed, right? So, for instance, the bond, this is how much money I'm putting in, and this is how much I'm going to get by this time, right? It's very stable because it's very determined. Whereas stocks, they're not determined, but they tend to keep growing. There's no cap on it because it's not like, okay, one day the stock is just going to stop growing. No, the stock can keep growing. So sometimes people will do stocks or bonds, maybe they'll do both. What's interesting about choosing either or doing both is the interest on bonds. So when you look at the market, the stock market, there's an average return, right? Depending on the index, depending on your how aggressive you are with your strategy and investing. The market might, these are not like real numbers, these are just example numbers. Let's say the market is going to return 4%, right, in growth. A bond could be 3.5% interest that you're going to get, right? So you think, well, the stock market's going to give me a half a point more in interest, right? In growth. But maybe it only grows 2% that year. But your bond would have been more, would have exceeded the stock market by 1.5 points, right? So that's why you look at what's the interest rate you're getting versus what is the market returning. And the market tends to over time return more because, again, it's growing longer, more things are happening to it. The longer something happens, the more change will happen, the more growth. But the bond is fixed, but at least you know what the bond will be. I know, okay, I'm going to get 4.5%. I'm going to get 3%. Whatever it is, you know what you're going to be getting. That's why it tends to be safer. Okay, so let's go to the next slide. So, what situations in life might make adding bonds more important to you? So, I'll give you guys 3 minutes to answer this as well. Okay, let me see. All right, Evan, can you share with us what you came up with for the workbook question?
Um, I just joined, sorry.
No,
Um,
you're good. You're good.
am I making bonds more important for you? I would say for me, I think, um, just trying to, I guess, make more like better financial decisions and just like I guess trying to like I guess build more of a future for yourself, I would say. Because like of the outcome of the bond.
Hmm.
Yeah.
So one thing with any of these questions when it comes to finance is this is something, right, when we talk about goals, about knowing ourselves, right? Is it has to be realistic for you, right? How realistically, like how much time do you plan to spend researching stocks and bonds, right? Researching real estate, what's involved with real estate. What are the different real estate classes? One market versus another market. What are the local rent control laws, things like that. That takes time and research, right? That's why fortune favors those one who wait, because you tend to get more money the longer you hold on to something, and also those who do the research. So if you're just like, I'm not going to do the research and I don't have the patience for it, maybe you turn that over into the bank. Maybe you have the like, hey, I have $10,000 that I've saved up. You manage it. That's why they have basically managed accounts where you tell the bank, I know nothing about the stock market and I don't want to know anything about it, but you know a lot about the stock market, so you invest it. Again, those things come with risks, right? Because you're not doing it, someone else is, but you're trying to diversify our bank on that this is what they do for a living, right? This, all about the stock market and you'll do it better than me. So a lot of this stuff, when it comes to your comfort level, it's how much do you trust yourself to do the research and be committed to it versus potentially how much do you trust someone else who's done the research to do it. And so the more you know about something, obviously the better you might feel for someone else to do it. So you don't want to just not know anything about the stock market or real estate, but you also want to know your limits. Like if it's just not something that's interesting to you, but you see you could benefit from it, perhaps you might put your trust into someone who does find it interesting. When one of in the chat, the question came up for day trading. So to share with you guys what day trading is, it's kind of a term that's used in talking about stocks. It's someone who on the day to day is monitoring and buying and selling stocks. So a day trader would be someone who, tries to time the market, right? They're very close knit with their research. They're on top of it. They're looking at things. Um, and so they're trying to time it or like, I'm going to buy it low and I'm going to sell it high, right? And so they're trading more frequently. They could be trading on a daily basis, a weekly, a monthly basis. And they might make gains faster because they're doing it so quickly, right? They're taking the money that they made and they're buying another stock that's low. But you have to know a lot about what you're doing, and there's a lot of risk, and it's something that like day trading is like a job, right? Because you got to be tracking things, you got to be looking at the news. If you're on the West Coast, the stock market opens on the East Coast. So you got to get up earlier to time that market and know what's going on. So it becomes like a job. That's what day trading is. So you could potentially lose out because if you just bought the stock and left it, it would grow over time. But a lot of the time people do day trading because they're trying to make money faster. And that's why they might make it fast. That's why they might lose the money. So it's not a thing that a lot of people tend to do. Or when you hear about it, it's like very specific to like a person that day trades. But most people sort of buy things. They try to time it. They try to buy stuff when it's low. They try to potentially sell it when it's higher. Maybe they bought a really risky stock and now they want to take that gain and put into a more less, yeah, a less riskier sort of vehicle, maybe a bond or another type of stock. That's what day trading is. Day trading is a lot of work. I'm out of breath explaining it. Yes, you've got to be very strategic and smart about it. So again, if you're not the kind of person who wants to do research about a specific company that does windmills and renewable energy, and you're just like not into learning about new renewable energy and specifically windmills, maybe you don't invest in a company that sells renewable energy stock, right? Or maybe you invest in a sector that you tend to know a lot about and are super passionate about, which could be renewable energy. So it varies by the personality type as well. Let's go to the next slide. So the basics of real estate. So property, rent, and long-term wealth. This is what I deal with every day of my life. I deal with real estate. Predominantly, I deal with my clients' real estate. And there's different paths that I've done in real estate. I used to manage real estate. I managed apartments, warehouses, and single family rentals. And what I could tell you about real estate is that depending on where you buy, it's a lot of work. There's jurisdictions that have less laws, but their rent growth might be lower. There's areas that might have a lot of laws and a lot of rules, but their rent growth is a lot better. There's areas where there's not a lot of jobs, so the rents are going to be low because there's not a huge demand. There'll be areas where there's a lot of jobs, and so the rent growth will be high because there's going to be a lot of demand, but you might have a lot of potential turnover. So with real estate, there's different what they call asset classes. And I'm not going to get into the A, B, C class. There's A class, B class, C class, but I will get into the more generic terms that you might know. So there's the type of real estate that's like a single family home. So it's the one that you usually buy and you live in. The financing for that is the easiest to get for the most part. Usually you have to have some sort of, down payment saved up, but there is first-time home buyer grants that you can potentially get access to. If you're the first person in your family to be buying a home, they have different grants for that as well. If you serve in the military, they have favorable financing for vets. So there's different financing for you to buy a home. Additionally, when they look at financing for buying a home, it's up to 4 units. So the bank looks at you buying a house the same as if you're buying a fourplex. That's what they call it in the industry, a fourplex. So there's, within that, you could potentially buy maybe a duplex, a 2 unit, and you live in one and you rent out the other, and that could help offset your mortgage. In the meantime, year over year, the property goes up in value, but your mortgage tends to stay the same because you usually have what they call a 30-year fixed term note or a mortgage. So your mortgage stays the same. Your insurance might go up every year, your property taxes go up a little bit every year, but the mortgage, you kind of know what that's going to be. And this is where you want to also do research on what's the insurance market like? What are property taxes like? Some states don't have property taxes. Some states have it, and at a county level, property taxes could be higher in one county than another county, right? So those are things you start to think of. But mainly you tend to buy real estate, usually where you're at, or if you're an investor, then you do your market research on a market that makes the most sense for you. So after you have the single family or the 1 to 4 units, then you can go into what they call commercial real estate. And commercial real estate is apartments, and it's also the office building. It's also the industrial complex. It's also, the retail. So it could be the strip mall, the actual mall, could be warehouses. Those are all parts of commercial, right? Within commercial, there an apartment is a very different investment than a warehouse. A warehouse could be a very different investment than a strip mall. So these are all kinds of things that within themselves have very different nuances. And some people, if they go and they want to do commercial real estate or they want to invest in it, they tend to fall into it because of the exposure that they have. Either they know someone who had it, or some people end up buying commercial real estate because they have a business and they use what's called the SBA, which is a Small Business Administration. They have loans to help businesses buy buildings, right? Maybe you have a business and you're outgrowing the space you're renting and you want your own property, right? You want your own warehouse and your own yard. The SBA can help you with getting financing so that you can purchase that. And then you have a company and you also have real estate. So those are sort of the different kinds of real estate you can have. There's also additionally what they call a REIT. So it's where what they kind of do is they syndicate or they bring money together And the group of people that are real estate professionals take that money and based on their collective experience, pick real estate. And then they manage the real estate and then you get a return on your money. And you don't actually have to do the day-to-day operation. You're just an investor. So that's what the REIT does. So a little kind of like similar to the stock market, but just different, right? So it's money that's being pulled together and it's being invested in different types of real estate. So it's different than stocks and bonds. Real estate is physical. You are investing in something that is there, that you can touch, that you can see. Real estate builds wealth in that you collect money from in the form of rents, um, and or equity. And usually you in some places have both. Like for instance, in Los Angeles, you tend to have both. You have rental money coming in that ideally you're collecting, you know, at least what it's costing you to have the building, but in the background, the building is going up in value, right? So you have rent income, but you also have equity. So over time, as your building gets equity, so let's say you bought the building for $1 million and 5 years down the line, it's worth 1.5 million. You can go to the bank and go, hey, I bought it for $1 million and it's worth 1.5 million. I want to get access to the $500,000 that my property has gone up. And the bank, looks at it. If it's a rental property, they go, okay, well, what kind of money is coming in? Okay. We'll give you a percentage. So they usually give you up to 60, 70% of what your property is worth. So then you can get access to that money. And with that money, you can buy more real estate. You can maybe make improvements to your existing real estate, maybe remodel units and get higher rents, things like that. So that's how you're able to access the equity. You borrow it from the bank. So that's kind of a very big topic, but that's a very common way that people grow wealth. And it's what you tend to kind of understand when you hear people have real estate. What they typically really mean is that they have access to capital, have access to the banks. Most real estate has mortgages on it. And that's kind of a different game. That's what I deal with a lot. I deal with mortgages and creating what's called upside, creating equity for my clients so that they can either sell property for more money or be able to get more money from the bank and get a higher return on their investment. So you don't have to buy the whole property. So the property that was worth $1 million, if you bought it, you probably didn't buy it with $1 million cash. You probably put maybe $200,000 down, and the bank gave you a loan for the other 800,000, right? And then the interest rates become a factor. How much is that money costing you? Usually that's tied to your credit score. So remember we talked about last semester how important it is to have good credit. They will look at your individual credit when they decide if they're going to give a loan or not. Though owning property, like all things, comes with risks and comes with responsibilities. That's why there's different kinds of asset classes. If you're going to own an apartment building, that comes with a lot of risk and a lot of responsibility because all of the repairs are on you. And every city, every state has different laws about what the unit condition has to be at all times for the tenant. Whereas if you have a warehouse, a lot of that responsibility is on the tenant to make sure that they're keeping up with the utilities, making sure they're keeping up with maintenance, right? So you shift a lot of the liability to the tenant, but because the tenant has a lot of liability, your rent might be a little bit lower or your rent growth might be a little bit lower because the tenant is paying a lot of the costs. So upsides for real estate, it's tangible, it's physical, you can see it, it's there. There's rental income. They're historically good against inflation, meaning that property values tend to outpace how much the cost of things go up, right? So your property is gaining value, usually more value than the change in what it's costing you to live your everyday life. And there's potential for long-term value and growth. The downside, there's high upfront costs, meaning it could be the money that you put down. It could also be that you have to, when you purchase something, maybe right away have to make repairs so that it's in an operable condition or condition ready for you to either use the property or live in the property. Maintenance, our management responsibilities are fees. So if you have, an income property, something that you're renting, you might hire a management company because let's say you're a doctor, but you want to diversify your money, so you buy an apartment. Well, you're a doctor, you're not going to have time to answer the phone for the like, hey, my toilet's not working. Can you please come fix it? So you might hire a management company. And their job is to make sure that the money comes in, all the bills are getting paid, and that the tenants are attended to. Because when you're a landlord, your tenants are your customers, right? And so many people that are working professionals, lawyers, doctors, people who have businesses, restaurants, etc., whatever it is, they diversify by buying real estate. But again, it has a lot of responsibilities. So sometimes they delegate that to a management company who does it for a fee, usually a percentage of the rents that come in, between 3% to like 10%, depending on how much management is involved. And it's not, you can't easily sell it. So a stock, you can click, 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 it's sold. Done. The money's in the bank. Whereas with real estate, you got to list it. People come in, they look at it, they do inspections, they haggle with you about what they're buying. It doesn't move. So real estate isn't what they call liquid, meaning you can't get the money out of it as fast. Whereas stocks are more liquid. Cash is liquid. You can immediately use cash. But again, it's part of their plan to diversify your investment. Your real estate will grow in value, but it'll grow slower, right? Than the bond that's going to give you an immediate, interest payment. So let's go to the next slide. So I'm going to give you guys 2 minutes on this one. What interests you more about real estate, long-term value or rental income?
Sasha, I think you're on mute.
Okay. Thank you. Is Irene Nunez here?
Yes.
Okay. Why don't you share with us your answer?
Um, I put that I'll be interested in long-term value because I think it like grows wealth over time. And I think rental income would be nice, but I would rather have like wealth over time rather than rental.
Okay. How many of you plan to buy real estate at some point in your life? Okay. How many of you are nervous about buying real estate? Are you guys nervous about being landlords? Yes. So that's why it's very important, especially when you're dealing with real estate, which, is interfacing with tenants. You get as much as you can as far as research goes and hiring, skilled professionals to help you, anything that you do. But it can be incredibly rewarding. So let's go to the last slide. Actually, let's go to this one. Yes, understanding your paycheck. There are a lot, there are a lot of laws about landlords and against landlords. There's always something about striking a balance, and not always is there a balance. But there's definitely a lot of rules that you have to be aware of. For our next class, we're going to talk about understanding your paycheck. So the amount of money that you get, like your salary, your hourly rate, is not the money that gets put into your bank account at the pay time. There's going to be things we're going to talk about, like your W-4 and what that means for your tax withholdings, and getting a W-2, which is your annual summary. Then we're going to learn about reading your pay stub and how do you interpret tax forms to make, informed choices and you're not surprised come filing your taxes, and some clear guidance and examples so that you'll master the basics of your paycheck and, how, what to do with spending your money or to know how much money you have to spend. So let's go to the last slide. I'm going to do the announcements for the first time. Hopefully I do this right. So we're gonna have the field trip for the Junior Achievement Finance Park. I will not be able to make it to the February 7th, but I will be there. And my 13-year-old, she will be with me if she gets up on time to do the finance park, which is going to be super fun. I went to it last year and it was a great experience. If you haven't been to it, you definitely have to go. If you've already been to it, come again. It was great. So make sure that you RSVP. There's only 2 days left to RSVP, which is January 30th. We also had the Ignite Speaker Series with Miller McCoy. That's going to also be on February 2nd. That's next week. So make sure that you RSVP for before the deadline, which is also January 30th. Um, for student leads, the student leader forum is now open. So this is where you can lead small groups, support your classmates, and keep the energy alive in workshop and events. The deadline to sign up for that is February 12th at 5 p.m. So if you want to be a student leader, you can sign up for that. There's the college match program, which I believe is involved with your school. But if you have any questions about that, feel free to reach out to the team. But you'll be able to keep track of whether you're currently involved in a college match program, or if you're not currently involved in one, potentially be able to get involved. There's also a Mustang immersive experience, which is now through Sunday, February 8th. So that would be next Sunday. It's free for you guys. If you want a ticket, there's a form that you can fill out that'll give you a unique code. I think you're able to get 4 tickets, but you'll be able to go to that. So if you are a car fan, that will be great for you. And then the First Gen U Career Spring Institute is now open. So designed to support first generation college students. So if any of you are first generation, so no one in your family has been before you to college, usually your parents haven't been to college, and this is your first time kind of going through it and you want more guidance on it, you can sign up for this and it'll help you. This is open for alumni only. But this is to help you guys explore careers and building professional skills. Other than that, I think I made it on time. If you have any other questions, because I'm not great at doing announcements, by all means, feel free to reach out to the Youth Champion staff and they'll get you all the information that you need. Please be sure to turn in your workbooks. They're due Friday by 5. If you can, do it right now so that you don't have to worry about it. Other than that, I will see you next Wednesday. Bye, guys. Good night.
Bye. Thank you, everyone. Thank you, Sasha.
Thank you. Thank you.